Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor. Ready to track the monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides the educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not the service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and will not distribute or sell your information to anyone. All right, fantastic. Now, what goes on next? Okay, so what have we? Well, first of all, let's take a quick look at the markets and see how things are going. All right, oh, that thing stays on top. Isn't that silly? This doohickey stays on top if you don't close it. I don't know if you guys can see it. Oh, no, it seems to be grayed out on your screen. Wait a minute. Maybe there's a way to show something else here. Disclosure, name, share custom region. How weird. Nope. Okay. So there might be some way to turn this into a chat thing. Anyway. So look at this. Look at this freaking thing. 20 points on the Russell in one day. That's just crazy. That's a 1.5% move because it dropped 10, which is 0.75. Then it came back up 10, which is 0.75. So it's actually it's a 1.5% move from the bottom to the top here. And it's not like it doesn't do this a lot. Here's a 1.5% move down, 1.5% move up. Here's 1.5 down, and well, or not quite 1.5, but whatever it is, 1% down, and 1.5 up. I mean, it's just freaking amazing. It's completely out of control. The S&P is a more realistic 0.48, and if we look at some of the other indexes, these will be smaller, but everyone's doing what they're supposed to do. And what were the lines that we were looking for today? Let's go over that. This morning we talked about it in today's post. The DAX ended up just over 11,000, so that's not really that strong, frankly. The lines we were looking at for week downs was Dow 17,850. Oh, wait. I can look over here. So hang on. The Dow's 17,9, so just over the week. S&P 2090. S&P's at 2094, just over the week. NASDAQ 5025 was weak. 5050. The NASDAQ just got to its strong bounce. The New York NYSE is at 10,964, so it's still weak. It's actually stuck at the weak bounce line, the New York Stock Exchange. And the Russell just plowed up to 1260. Actually, the index itself is at 1270. Are the futures that far behind? Well, all right. So the futures are 6 points behind the index. So the index itself is blasted past strong. So we have the Russell is firmly green over here. The NASDAQ is right on the line on strong. The New York Stock Exchange is the only one still red over here, and the others are in between. All right, so on the whole, we're more or less getting the weak bounce we expected, except for the Russell, which is always the index that goes up and down like crazy. But our big watch point, though, is Germany, and Germany only hit our weak bounce point, which is at 11,250 was the week down. So this is it really is barely holding what essentially is the must-hold line for Germany. But this is not a very impressive performance on the whole. All right, anybody seeing anything? Let's see. Chrissy asks, why did you feel the sell for SDS? Yeah, we just called it out in the chat. Am I recording? Yes, I am. Thanks, Greg. Okay, Q&A. Oh, don't use this Q&A. I have no idea how you even get there. Jiao. Oh, Jiao said sound is good. Okay, well, I'm glad the sound is good, but I'm not using that that box. All right. So what did Savvy say? Chrissy said, sorry. Why do we sell SDS? Because, first of all, because we try to be not greedy. SDS was in our short-term portfolio, and I just put out a call to dump it. Not SDS. Wait. Oh, I'm sorry. I was thinking of FXI. This is our long-term portfolio. It's at 47.6 at the moment on this little bounce, and the short-term. We're not getting damaged too badly by this move. I think 137 we were at yesterday. 7%, 7,000. So that basically cost us $7,000 for the market to bounce like this. Let's see. I'm sorry, I wasn't thinking SDS. I was thinking FXI. We just made a call in member chat to sell these FXIs, the July 50 puts. They were $4 when I made the call a little while ago. Now they're down to $3.95. And wait, this will be better to show you, I think. Finviz. Oh, no, not that, not those charts, sorry. These charts. Opening a new tab. Damn it, not that chart either. I gotta find one of these with the lines, yeah. I don't know the URL, but if I open the same one with the line, here you go. So if I open one of these in a new tab, then I can just change the little thing here. That's the only way I know how to do it. FXI. So in chat, we just made this call because Palate said, see, this is why it's good to have check. You guys remind me of stuff, which is really important. So Palate said it's another good day for FXI puts, and he asked what our target is, and he thinks he's selling half. Well, yeah, damn right. It's like, look, we had a good down day on FXI. We jumped all the way to $4. So my call was, I was hoping for 45, but I think $4 is good. Because how much are we going to make at 45 with the $50 puts? We're only going to make $5 at 45, and that's if it goes there. If it doesn't go there, we'll never see $4 again. So what's the point of that? So right now, because you have to realize that, it's like we have 4 now, but FXI is at 47. It's actually, it's only, our thing is only worth 3 over time. So if this happens to be the bottom, we'll never see better than 4. 4 is $1 more than the position stage. Therefore, since we're getting paid 4 when it's only worth 3, and 4 is 100% gain off of where we entered this thing not very long ago on 5/21. So in less than a month, we're making 100%. Why leave it on the table? Also, circumstantially, what happened today? We had a good sell-off, right? We know we're bouncing, obviously. So if we're bouncing, maybe China's going to bounce tomorrow. If all of our indexes are making a big bounce like this, and if the Russell is bouncing 1.5% off the bottom, then China might bounce 1.5% off the bottom, then we're going to be screwed on our FXIs. So why risk 100% gain? It makes no sense. All right, so that's why we took that off the table. So Chrissy, similarly, yesterday, let me see if I can find that. Here's Tuesday. Here's the portfolio review. Here's one we're not using. So then yesterday, at 11 o'clock, I said, let's lock in some of these gains on SDS because we had a rough ride on those things. Selling the June 2050 calls for 42 cents, all right? So here's SDS. Well, let's go back to that thing. So yesterday, well, it was yesterday, right? Yeah. Let me see if I can find Yahoo. Do I have Yahoo up? I don't. Virtual portfolio review, Monday meltdown. All right, hang on, I'll pull that chart up. So with SDS, the 5-day chart. So yesterday, at what time was it? At 11 o'clock, okay? So what happened at 11 o'clock yesterday? At 11 o'clock yesterday, which is right here, 11 o'clock, 11:10, 11 o'clock, right there at 11, I said, let's take our SDSs. No, I didn't say let's take them off the table. I said let's sell, because we had this nice high in SDS, right? And as it was going down, I got worried that what if it keeps going down and doesn't come back? Because we have the July $20 calls. So I said, why don't we lock in our gains here by selling the 2050 calls for 42 cents? Because I thought the S&P would bounce, and if the S&P bounced for 42 cents. So in other words, we sold the short 2050 calls. See, 2050 is right down here. We sold the short 2050 calls for 42 cents. So effectively what we did is we locked in 20.92. See this high? We locked in this high of 20.92 by selling the 2050 calls that expire on Friday for 42 cents. So that locks in the gain that we made on SDS from 20 all the way up to 2092. So now if it falls back to 2050, we still get that 42 cents. And what does that 42 cents do for us? Well, on SDS, I mean, aside from being a good amount of money, considering it was the original position was, I forgot. Okay, where is it? Now it's being moved because it went to a spread. Here it is now. All right, so we picked up these guys for 79 cents back on 5/29. Now we sold, these are the July 20s. Now we sold June. It's going to expire. That means, though, that our net now on the 50-cent spread is now 37 cents. Now, you know, frankly, making 13 cents on 37 cents is fine anyway, even if that's what we did. But the idea was it was just timing, as in we wanted to lock in that gain. And now when these 42, if they expire worthless, they're going to help pay for a roll. Because now we have the SDS July. Let's see what we have. We have the July 20s that are now valued at 88 cents. They just sold for 88 cents. It just changed. And what we can do with that money now is we can roll them to the next month, where it's $1.35. So that 40 cents pays for almost the entirety of that roll to September to give us 3 more months of protection on the SDS. And when we do that roll in September, then we could sell like the July 21s or the July 22s for that money. Now, what if SDS goes higher? Well, if SDS goes higher, you look at the price of the 20.50s that we sold. They're now 25 cents. And we look at what July's at 25 cents. Well, that's the July 22s. So our worst case is we would roll the June 2050s to the July 22s. This would only happen if SDS went up and we had to roll the short calls. Then we would roll it to the July 22s, and we still have a $2 spread, and we only bought them for 79 cents. So that still makes us a ton of money. So that it's almost a no-lose situation. So you say, why do you do it? And the reason we did it, Chrissy, is for this. Look, $4,200 is why we did it. That's cash money. We did it because we were able to make $4,200 because somebody gave us $4,200 cash so that they could bet that SDS would be higher than 20.50 on Friday. And they gave that to us yesterday. And we were in a position to take that bet because we had the foresight a few weeks ago to take the July 20 calls. That gave us a position that protects us against the short sale. All right, so you understand that? We took advantage of our position. You can't not take advantage of these things. You can't have these positions and just sit there and stare at them, especially when you sold the premium. We sold the premium on SDS. We're burning cash by owning that position. When we made money, and we made good money, when the thing went to 20.90, we were up over $1. I was almost going to take it off the table, in fact, yesterday. I can't tell you exactly where it was, but it was over $1. And over $1 is a 21-cent profit on 79 cents. It's like 25% profit. I did want to take that profit because I thought we could do better, but I also didn't want to let go of the protections. If I sold these, I just had to buy something else to go for long-term protection. So I said, well, instead of selling them, and then I looked and I saw how expensive those 2050s were. I said, wow, let's sell those because we can get 42 cents. So we took an opportunity. And that's what you have to do when you're doing these options. You always have to look for the opportunity to sell. Look how you can be the house. Look for where there's a way that you can sell some other sucker some premium and let him take the risk. And then you just sit back and collect your money. All right? So that's the short answer as to why we did that. All right, so where are we? That's what we teach every day here. That's exactly what the point we're trying to get across. This is how you should be thinking about your option. How can I make money off of this thing? If I own an option, how can I use my position now to make money? That's what you got to worry about. Hey, what was that thing we took? Netflix, right? What happened to them? Damn. Even though it's a 663, those 700 calls are still $26 or $23. It's crazy. We're going to have to ride that sucker out all the way till the bitter end now, I think. All right, so back to questions. Where are they? Meeting burner? There they are. All right. Pound. Oh, that's not good. And the dollar's down and the NKD is rising. Yeah, all that. Yeah, I mean, look, everything's doing what it's supposed to do when they're pushing the stocks around. All right, and then SDS, by the way, I sent out an alert. I sent out an email alert to everybody. So anybody on our list should have gotten that yesterday. That was a big deal because we had to do that sale. It was a big. It was. I mean, why would you not? It's $4,000. All right, so what are we going to look at? NKD and the dollar, right? As we mentioned. Well, not much of a bounce. So the Nikkei hit all the way down to here, about 20,150. Basically, stopped at that line. And now we're back to two. Wow, so it's a big jump, right? It's up almost 150 points. It just doesn't look big in the grand scheme of things, but it is quite a big jump. But still, it's only weak bouncing. That's all it's doing. You know, if it's off the bigger chart, this is just a weak bounce. The dollar is not particularly weak. It's not, I mean, it went down a little bit, but I wouldn't call that against the dollar because the dollar is flat to where it was yesterday. That's what's important. Forget the zigzags. Where is the dollar compared to where it was this morning or where it was yesterday? It's really flat, basically, to where it was yesterday. So this move in the Nikkei is just, like I said, basically this is a Greece's fixed rally. Everybody's got the same rally point right here. This is all from where Greece said we are willing to talk some more. And everybody said, ooh, thank goodness Greece is going to talk some more. That'll save everybody. And that's where we are. So that's why it's funny when you read these things and say, oh, Greece isn't a big deal and we shouldn't pay so much attention to Greece. Well, how come the markets react to every sentence that comes out about Greece? And everything any minor minister mentions, they go crazy. So Greece does matter. Greece is kind of important, actually. We got gold. We need gold to hold this 1180 line. It is so far, thank goodness. We have a big bet on gold with the Friday, June. You know, June expires on Friday. We have the Friday 112, 113 bull call spread in GLD, and that's right about this 180 lines, 1180 line. So 1180 on gold pays us a nice double on that one. So that's what we're looking to hold on gold. Silver's drifting below 16. Bounced off 1185 again. It's getting stronger. It was falling down to 1575 and 1550 even. Holding 1585 is progress for silver. You see over here it was 1580, and then here's 1577, which is like 75, And before that, well, we don't go that far back. Let's go back to last week. So it's kind of that bottom channel on silver is rising, and I guess you could see that. Where can we see that? Okay. This one, show it. And put it in the store. That you can't even see. It's a very, very tiny rising channel. So here it's like it's pulling up very slightly, very slightly. It's gonna, I think it's gonna pop 16. And the real question is, what's it gonna do at 1650 when you got the 50-day moving average coming into the 200-day moving average? And the 200. Oh, one of the things these 200-day moving averages are useful for, or the 50 for that matter. But when it's down sloping like this, it means it's going to be pushing hard down, right? Think of it like a physics problem. So the 200-day moving average is coming down at not a hard angle. So you want to come up at it at a hard angle to break through. If you come up at it at a soft angle, see this hard angle here? See how this is coming at sharp, right? It's a sharp angle, and you punch through it like it's a piece of paper. When you come at a soft angle, where's the soft angle? Oh, here. You see how this one went up sharply. See how it softens up here, though? That's how you know it's going to get rejected, because it's coming in too wimpy. It doesn't have the force to get over, and it fails. All right? And the same thing here, though. This guy came in soft, so he bounced off it. Then he comes down sharply and punches through it. That's how these things work, okay? So to some extent, it's a matter of how much force something has. How fast is it coming down? It gives it like a sort of like a top spin, like a tennis racket. So depending on how fast you're going or how slowly you're going, that's how much the effects of these moving averages can have on you when you hit them. They also will tend to stop you. You know, when something's flying into them, it'll tend to stop you. Like even this goes up sharply, it stops dead at the 50-day moving average, but it consolidates along the average. And by consolidating along the average, you've got a pretty good idea it's getting ready for a move up, not down. Because if it was going to go down, it would have been rejected especially after 2 weeks. You expect to see it being rejected by that. If it's consolidating along a positive line, you got a good chance of something going higher. That's what these lines are good for those bigger overviews and get an idea of like where the overall buying and selling is. And also you want to watch your volumes and so on and so forth. So in this particular case, though, this is why we say 1550 is not going to crack. Got serious support down here. That's the EMA. All right, that's the exponential moving average. That's not going to crack at 1550. Basically, that's a pretty hard line. And the trick is, though, what we want to know for silver is will it get over 1650 or 1675? I think not, though, because what's going to happen here is by the time we get up here, since it's inching up very, very slowly, by the time we get to 1650, this will have come down to 1650. And since we're coming at this really wimpy angle, unless the dollar sells off considerably, see, here's how I make predictions, because then I'm looking at it and say, well, okay, unless the dollar sells off considerably, there won't be enough force to push silver higher. Now, or there could be sudden demand for silver, very unlikely to happen, right? So now my question is the dollar likely to suddenly go lower? No, it's not. Even if they fix Greece, it's still really not going to help. I don't think it's going to weaken the dollar that much. It won't strengthen the euro or weaken the dollar that much. It will help, though. So if Greece is suddenly fixed, silver might pop up quickly against a weaker dollar. And then you say, well, how much could the dollar fall? Let's say we think now let's look at the dollar. And we say, let's look at the U.S. dollar. This is all the stuff I look at. When you guys say, what do you think silver is going to do? I have to do all this before I even answer you. So we look at the dollar, and the dollar has good support at 92. All right, so it's not likely the dollar is going to fall more than 92 because you got that serious line of support that hasn't even been tested in God knows how long. Look at the last time it tested it was last summer was the last time it even tested the 200-day moving average. All right, so that's not likely to fail. So let's say that Europe suddenly fixes Greece and the euro flies up, right? So we also want to look at the euro to see where that looks like and see if that has resistance too. But so we're talking about 3% on the dollar, ex EU. The hard thing is remembering all these symbols. Now, the euro has resistance if it goes up 3%. See that? So it's a little more than 3%. But anyway, so the euro is going to start running into resistance up here. So it's not likely the euro is going to pop right through there. It's not likely the dollar is going to fall below its resistance. So we're talking 3%. So now we go back to silver, and we say, well, what is 3% on silver? So 16 times 3 is what, 48 cents? Is that right? Sounds like a lot. No, maybe not. 48 cents, right? 16 times 0.03. Yeah, it is 48 cents. It seems like a lot. So it actually lines up perfectly. So what's going to happen if the euro pops and the dollar drops? Then we think then silver should hit 16.50. But unfortunately, at 16.50, it runs into resistance. And since we don't think the euro is going to go higher or the dollar is going to go lower than that, then probably the silver is going to hit 16.50 and then hit resistance. And probably, though, I think it'll consolidate there. It won't fall below it because I think the euro should be a bit higher and the dollar should be a bit lower. So between the two, we're going to kind of find the right price. So we're back to, and that is where it should be, though. Silver should be here at 16.50. That's why that blue line's there. 16.50 is the correct price for silver, more or less. And if you look at the and the 200-day moving average is 16.75. So yeah, this is the correct spot for silver. So what I would look for in silver, was anyone going to ask me about silver? How do we get to this topic? Anyway, what I would look for in silver is for it to go to 16.50, consolidate there, and come up around 16.75. But this is the correct price. So we should see some consolidation here, and then finally a move higher for reasons other than just currency issues and for overall reasons of demand and so on and so forth. We'll start seeing some movement in the silver market probably towards the end of the year. But anyway, that's why we have the silver wheaten trade in the long-term portfolio, because long-term I think silver is good for a move somewhere around 17, maybe 17.50. You know, I think it's going to go into a nicely higher spot. Is this a long-term portfolio? That's a short-term. So in the long-term portfolio, we have, every time we look at the long-term portfolio, it gains another like 10%. Okay, in the long-term portfolio, we have a very aggressive trade on silver wheaten because we sold the puts and we bought the calls, but we never sold any short calls. Oh wait, we did, sorry. Wait, what is this? No, that's right. That's right. I was just looking at the wrong thing though. We sold these puts, the 18 puts, and that's very aggressive because we're at 18. So we sold the $18 puts, which means we don't think silver is going to go any lower than that between now and 2017. And then right now you can still do that trade because they're the same price basically. And we bought the $15 calls, which we are taking a hit on so far. So also still, this is a better entry than we started with. And when it pops, we're going to cover. So when we test that 50-day moving average, we're probably going to cover. And again, this is how you make these calls. This is how the timing comes about for these calls. Because, you know, like Christy was just saying, why did you cover there? Well, that's kind of why. It's like, because I look at all these different things, and I say, okay, well, when you get to this level, that's going to be about the right price. It's going to stop there. All right, so if I think it's going to stop there, then the next trick to do is to know that the options give you the best price at the moment when the stock is racing up. You don't wait and see, you know, because if you wait too long, the prices change on them. But you'll get your best price while silver is spiking higher. So on the day they fix Greece and the dollar is dropping and the euro is going up and silver is moving up with the dollar, that's the day that we're going to cover these $15 calls. All right, and if you want to get more into it, now again, if it's your portfolio, you should be getting this into everything. You should be looking at all this stuff. So when you look at it, then I'm going to go to SLW, and you should have notes on all your positions and say, here's what I expect to happen, and here's what I'm going to do when that happens. So we have the $15 calls. Ideally, we'd like to sell the $20 calls or maybe the $22 calls. I like the $22 calls because they're not much cheaper. It's only 60 cents cheaper to sell the 22s. So I would like to sell the 22s for $3. Now, is that realistic? Well, $3 would be 80 cents more than they are now. And it's a delta of 43. So it's going to move 43 cents each dollar. So now my question is, will SLW move up $2? All right, that's what I'm going to be looking for. So can SLW, where is that? Okay. So now I look at SLW, and I have to think whether or not I wish that would happen, but is that realistic? And not really, because see that? Same problem, though. You got your falling, these are shorter-term averages. This is only that's only the 20. Oh, but there's the 200s right up there, too. So the 200 is right about there. It would not quite, it's very unlikely I'm going to pop over the $2 range. And what else also, by the way? So 3%, right? So what's 3% of 18? It's 30, and 24 is 50-something. So really 19-something. All right, so now I have to look back at the options, and I have to say, oh, well, I'm not going to get more than like $1 move on SLW, which is going to be 40 cents. So will I want to sell these things for $2.50, $2.60? Well, I bought these for how much? Now I remember, I forgot what I paid for. I bought those 15s for $5.75. So do I want to take $2.50 for the short calls and be in that spread, or do I want to sell the $20 calls for $3.30? That's a tough one. I think I should probably be more conservative. I think I'd feel better if I took the more conservative place. So we're going to look. So now I'm going to change my attitude. I'm going to look to see if I can sell the $20 calls for something like $2.25. That's going to be my goal. So $3.25. Because if I sell that for $3.25 minus the $5.75 on the other ones, that comes out to $2.40 on the $5 spread. Plus, I sold these guys, the $18 puts, for about $3. So that means I have a 60-cent credit on the $5 spread. I like that. All right, so having a credit on the spread means the worst thing that can happen to me is I own SLW for under $18. That's my worst case. My best case is I get back $5 on the spread for my 60-cent credit, so I end up with $5.60 profit. And since we have a lot of them, that is the way I'd want to play it. I'd want to be a little bit more conservative because we have, 40? Yeah, we have 40 of them. So, I told them 40, if we make the $5 at $20, and we're halfway there now. We're at $18.40. So we're halfway to making the $5. If we make the $5, that's $20,000 profit off a $1,200 credit. I'm sorry, $2,400 credit. So the total profit is $24,000. That's what this trade is. We got a $2,400 credit for going into it at 60 cents each, and we'll do that. So do I want to be in that trade? Of course I do. Why wouldn't I? We're not in it yet, though, because we haven't sold the calls, and then even after we sell the calls, we still have the problem of the whole trade working out over the long haul, but that's a goal now. Now I know what my plan is for that trade. And that's how you have to identify. You have to look at your trade. You have to think of, what do I do if this happens? What do I do if that happens? What do I do if that happens? And you got to either have it solid in your head, or you need to have it written down for each trade. And that's why another nice thing I like about power options, not to do a commercial for them, but another thing I like about it is they have a little book pick. See this book here by every position? And they have a book here, and you can write down your notes. And that way, if you forget what you're in a trade for, you can check your notes to see what the heck was I planning. And then you just put a note in that keeps it for you. If you should do that. You should have a spreadsheet or a notebook or something that keeps track of all this stuff for you, at home. You shouldn't be looking at every position and be surprised by it every time you look at it. That makes no sense. You've got to have a trading plan. We used to talk about that in the education section. In fact, there's a phrase that says, plan the trade, trade the plan. All right? In other words, it's just how you have to look at every trade. It's like you have to have a plan for your trade. You have to execute the plan for the trade. Otherwise, you're just, drifting aimlessly. And if you have 20 or 30 positions, it's crazy. Then it's just like a sea of, what the hell's going on here? All right, anyway. All right, check on questions, see if anybody's interested in what we're talking about. Oh, you guys are not chatty at all, for goodness sake. Oh, we have a couple of people saying no, Sam. That's not good. It's going that way, right? Yeah, it is. Well, anyway, okay, fine. I don't care if you guys don't want to talk. I'll just say my own stuff. All right. So what else have we been doing today? Let's see what the people in chat are saying. I was talking about ARR, that's a dividend payer. Talking about whether it's worth sticking in ARR or not. I don't think I did a chart for that here. See, the problem is it's a very false trap. When you see these dividend-paying stocks, you have to understand the problem with them is that they're, the REITs, is they're taking all of their profits, essentially 90% of their profits. That's the definition of what a REIT does, and they distribute it as a dividend. So every time they make money, they don't invest it back in the business. They give it out to the shareholders, and they leave a little teeny bit in the business. That's not a recipe for growth. All right, so the more they pay out, when they pay huge percentage of dividends, sometimes the worse it is. It means that they're not really reinvesting. They're kind of milking everything they have and pushing it out into the thing. It's very funny though, because people, one of our guys invested in AR, and he bought them at 6, and they went to 4, but he didn't sell. Then they went down. As soon as you think they're dropping faster than they're paying you a dividend, get out. Because they're not doing what you wanted them to do. We came in here at about 3, maybe 3.20, whatever. So we came in with a buy right here, though I know our net is below $3. We collect a 4-cent monthly dividend. So we collect 4 cents and 4 cents and 4 cents. We're going to collect 48 cents over the course of a year. So I expect the stock to be somewhere like 280-ish is what I expect by the end of the year. All right, anything over 280 is a bonus because they've already paid me 48 cents. If you go into a REIT expecting it to go up while they're paying you money, you're in fantasy land. There's no reason that would happen. On what basis? The stock goes up because it accumulates profits into the company because there's return on investment that goes on the balance sheet of the company. That doesn't happen with ARR. It doesn't happen with any of the REITs. They pay it out as a dividend. A REIT that goes up is an exception, not the rule. And it takes very few REITs are going to do that for you over the long haul. Generally, you'll be happy if they stay flat. And we'll take a look at a couple of others just to make sure this is understood. So let's talk about, I'm blanking on what the REITs are now. SIM. We have NLY is one that we like. And see, what does NLY do over time? They'll go in and out of favor on fluctuations in the market, but over time, they're going to do this. It's a $10 stock. They're not going to not be a $10 stock. Sometimes they'll be 8 and sometimes they'll be 11, but they're going to be a $10 stock in general. Because how can they get higher when they keep giving me all the profits? And especially, by the way, ARR is a monthly profit distributor. So they don't even keep the profits, at least NLY keeps the profits for a quarter, so maybe they do something with it, maybe they change it, maybe they do this or that. ARR doesn't do that. Every month they're giving you the profits. Imagine if, imagine like the ice cream store in your town, all right, and every time they make profits in the register, they hand it out to their shareholders, right, every single day. So all it takes for them is to have one bad night, and now they don't have any profits, and they also don't have any reserve cash because they keep giving it out to the shareholders. They don't have anything in reserves, and they can't even take. So whereas a REIT like NLY might take advantage of a downswing in the market and will say, let's say the market goes down and NLY is sitting there with a bunch of cash and they say, hey, you know what? Instead of doing a dividend this month, why don't we go over to this other company and offer to buy some of their assets while it's cheap because all the REITs are down this month. And they go, oh, good idea, let's do that. So that's another thing I love to do. I love to jump on these REITs when they cancel their dividends because sometimes they do it for really good reasons. Anyway. So the point being, here's NLY, which is a fantastic one. The CIM is another one we love. They're not going to move off of where they are. They were going up. Actually, it's a really fantastic performance. They were going up because we bought them when they were way down. They were beaten down. I need a bigger chart. Yeah. Sometimes the chart's not big enough to show you what's going on. All right. So what seems like, see, here's the thing. What seems like like it was going. This is why charts can really mess with your head. Let's take a look. Okay. So here's CIM. We bought it here. We bought it when it crashed, and we started liking CIM. Exactly like ARR, though. Okay, it's the same thing. I'm taking ARR after it falls. That's when we're getting in. We're getting in at 3. We didn't get in at 4 or 5 or 6. All right, and the same thing with CIM. CIM, look at them. They were way overpriced at one point. I don't care. I wasn't a customer here. It's not my problem that there are people who don't know how to value things. That's their problem. We came in after it fell, after it stabilized, after it found a place over here, and they split. So this was like $3. It reverse split like 5 to 1. So it was like somewhere around the $3 line. That's when we started getting excited about CIM. CIM is the same management as NLY, same people. And but anyway, I'm not expecting it to make any money. This is from 2011. This is 4 straight years, no money. You're not in it for the money. You're in it for the dividend. And on CIM, let's see what their dividend is. Their dividend is like 13%. That 13%, and you combine it with the options, and you can make that 20-something% a year. Very, very steady money. It's a pretty stable investment when you do it that way. These are fantastic stocks, but you have to understand them, and you have to have realistic expectations for what they're likely to do. And then the other one that I like is AGNC is another one. AGNC is another REIT that I like. And by the way, I don't think CIM is in the long-term portfolio, is it? Maybe it is because I really like them. Oh, there they are. Yeah. Oh, we bought the stock, we sold the puts, but it hasn't gone up enough for us to sell any calls yet. So we're just in it and collecting our dividends. That was CIM. So what are we hoping for? CIM. Yeah. So what I was waiting to see is how much of a bounce we're going to get out of this thing. We came into this on 5/18 is when we came into the stock, and let's see that chart. Oh, here it is. So 5/18 was where? Right about here. So this is the spot we came in to CIM. We wrote it out lower. We didn't do anything about it. We were just waiting to see. I didn't know for sure this was a bottom, but it's a bottom as far as me valuing it. All right, so I was willing at that point to put my foot down and say, I think this is the right value. It went down a little further. Can't time everything perfectly. I didn't know it was going to. In fact, it did go up right after we bought it, so we thought we might be onto something, but it turned out that it went up and then it came down even further. But that's not the point. I'm willing to own it for this price. I thought that was a fair price, so I was willing to put my foot down at that spot. It did go down further. It didn't go down further enough to make us double down, though, which we would have liked to have done. If it went down to like $12.50, I would have loved to buy more, because $12.50, now you're back to over here. All right, so I would have loved it if it went down further, but that wasn't in the cards. So now it's going to go up here. I'm hoping it's going to test up around 15. That's where we're going to cover that one. And again, you see how that works? So all these positions, it's like I know what I want to do because it's like there's a plan for these things to say, hey, when it gets to this spot, then we're going to cover it and take advantage because I don't think it's going to punch right through 15.25. I don't see any particular reason for it. And why? Because it's a REIT and they give away all their money. That's why. Because they're not keeping the goddamn money they make. They're handing it out to their shareholders. That's not a good plan. I mean, it's not a good plan for growth. But do I think they're worth $15? Yeah, I do. I think 15 is a very fair price for them. I'll be happy to own them up here. And I'll be very happy if they keep paying me my 10, 12, whatever % dividend they're paying. All right. Any questions? Oh, now we have some questions. Let's see what happens. Is your audio option set to listen only? Chrissy said earlier, said you're extremely bearish on the overall market with China. So what is your thinking now short term? I think China's going to correct, and I think it's going to bounce in between the corrections. And I think we caught a nice move down, and we're going to take advantage of it. And if it pops, look, Chrissy, it's either going to pop, and we're going to get a chance to reshort it, like it's going to bounce, or if it doesn't bounce and it collapses, I'm going to say, oops, I guess we only made 100%. We missed the chance to get back in. It's not. I don't care if I make money on China going down, or Japan going down, or Egypt going down, or Greece going down. What's the difference? When I see a play that I think is obvious, I'm going to take it. And when I make 100% on my money, I'm going to take it off the table, and I'll find another thing to trade. We have tons of things that we look at, and I don't care what China does. I only cared about it because it was too high and it made an obvious trade that I could tell everybody about. Now it's not so obvious. I don't know for sure it's going to go down further because there's a very high chance that the Chinese government is going to step in and do something to try to stop it. And when they do something to try to stop it, it's going to pop back up, and then it's going to get to a point where I say, oh, now it's an obvious short again, because whatever they do, it's not going to be enough most likely. All right, so you say, what am I thinking short term? I'm thinking chaos short term is what I'm thinking. But I know it's not about changing my mind. I'm not suddenly bullish on China. It's just we made 100% on a bearish position. I don't understand. It's why beat a dead horse? It's like we made 100%. We cash it out. If there's another obvious play on China, I'll be the first one to jump on it. But I'm not obligated to stay bearish on China just because I think they're going to fall down. I already made 100%. I'll go, and now I can take see, here's the thing. If I take that 100% and I leave it there, maybe I'll lose 50% of that money, or maybe I'll make another 50%. But you know what? I got a better chance of finding another position, brand new, that I can make 100% on. And then I'll make 200% because I have twice as much money to play with now because I cashed out the first trade. You can't just let everything ride. That's how you lose your money. It's like, for God's sake, you have to realize, I made a lot of money. Making 100% on one trade is like making 20% on 5 other trades. So I get to be wrong 5 times now before I have to be right again. I have no pressure on me at all. That's a great position to be in. Ken says, why did you cash the FXI puts when you thought 45 what changed? No, I just went over that, Ken. Sorry, you can't be late to these things. Yeah, it's just we made 100%. It goes back to the same thing. It's like we made 100%. 45 would have been another dollar. Wait, let's see. So we started 2. So we started 2. We made 4. We got 4. That's 100%. So we could have made 150% instead of 100%. So that's what I was just saying. We're risking. So in other words, I think we can make 150%, but we already made 100%, and we have to. So should I wait till July to maybe make 50 and maybe lose 50, or should I just take the 100% and run? So ARR and the LTP is viable. Yeah, it's damn well viable. It's paying us 4 cents every month in dividends. I mean, it's more than viable. It's a little piggy bank. It's an ATM that just keeps spitting out 20s is what it does. On your ARR example, I entered ARR at 670 after it fell from 990. Using your logic, it could have entered at 5 after it fell from... But... No. My logic is to have a good reason for the pricing, and if it's not, and if it doesn't do what you think it's going to do, you got to get out. Now, with us with the ARR, we took a, you have to look in proportion. I mean, in ARR in the long-term portfolio, here they are. We took 3,000. 3,000 is $9,000. Our allocation blocks in the long-term portfolio are $50,000. So in any given position, we're allocating $50,000 to the position. So 3,000 at net, and don't forget also, it's the way we took it, because we took it at 317 minus, we sold the calls for 22 cents. So even though we bought it for 317, you have to understand that also. We bought it for 317, but we sold the $3 calls. for 22 cents. Why did we do that? Because we wanted to lower our basis. Our primary goal was to get a lower basis because we didn't have any faith that it was going to go higher. Because I expected it to go lower. Our target at 317 was to own it for $3. And then minus also. Then we promised to buy some more though for $3. Then minus 25 cents more. And we end up with a net of $2.70 on 3,000. So times, times 30 because I didn't do the decimals. So we spent $8,100 out of a $50,000 allocation for ARR. All right, so if ARR continues lower, we'll have to buy another $3,000 for $3. So we'll have to spend another $9,000. Then I'll spend. So let's say in January, if ARR is below 3, we'll be assigned another $3,000 at $3. That's plus 9,000 is 17,100 for 2,000 shares. Okay. At that point, now, before that happens, before I take that assignment, I might decide to take the loss or whatever. Between now and January, what do we expect to happen? Well, I expect from April, we missed the April payment, but we get May, June, July, August, September, October, November, December, and January. So we get 9 months of payments. So we're going to get 36 payments. So 9 times 4 is 36, times 3,000, wait a minute, somebody remember 17.1. So we get 3,000 times 0.36, what? That's not right. 3,000 times 0.36, that's better, 1080. So 17.1 minus 1080, right? So 17.1 minus 1080, so it's 16,020, and then we divide that by 6,000 shares that we would have on the assignment. It's $2.67 a share. So that's our expectation for breaking even in January. It's $2.67. We will have collected between the dividends we collect and the option money we collected. That's where we're going to be in January. Then what happens? Well, then we go and sell the next year 250 puts and calls. Let's see if they have 250s. They might not have them. They might only have 3. ARR. They don't have 250s. So we'll just have to see in January what happens. If they're at 267, we may sell the $2 calls. We may not. We may decide to sell the $2 calls and $3 puts or whatever. But either way, we're going to collect we'll probably collect more than that because hopefully the 217s will be out, and we'll collect more money than this because this is the money you can collect for 6 months from now. We'll be collecting 12 months. But if we can collect $1.50, even if we only do collect $1, though, you have to think about it. What's $1? If we knock another $1 off at 267, we're going to be breaking even at 167 by selling more puts and calls. All right? Now, again, over the course of the next year, we're also going to collect 48 more cents in dividends. Now, obviously, we wouldn't be pressing this play if we weren't pretty sure the dividends are going to keep getting paid, and we wouldn't be pressing this play if we thought the stock was performing worse than it does. But like I said, so our net is going to be 267. So as of January, our net's going to be 267. And all we have to do, let's say the stock is at 2. So let's say the stock falls 30% from here and is down at 210, let's say. All right? All we're going to lose is 50 cents times 3,000 shares is $1,500. So if the stock ends up at 210, we'll be out $1,500, and we say, okay, it didn't do what we thought it was going to do. What do we think? I think it's going to be higher than 267. I think it'll be close to 3. And the closer it is to 267, the less likely I'm going to want to continue with the stock. But that's a break even. If it's under 267, I'm almost certainly going to say, no, I guess AR performs worse than I thought, so we should get out. But I'm sure it's still not going to ride it down to $1.50 because, again, I have a trading plan. And when you started, I'm sorry, I forgot who that was. If you started at $6, that should have been your trading plan at $6. it's really Francisco. If you entered at 670, you should have had a trading plan like that. You've got to say, I'm buying at 670 because I expect this, this, and that to happen over the next 6 months. And in 6 months, if I'm not on track, I got to get out of this thing. So you entered at 670 after it came from 910, and I don't want to use you for a bad example, but I mean it's important if we're talking about this thing. Where's my Yahoo? There it is. So we look at ARR. All right. Oh, can't really see it there. Oh, here we go. All right. So it fell from 9 to 670, and Francisco feels very clever, and he came in, which is really using the same launch values, right? He may have. I'm not sure where, if he got in right here, if he got in over here, whatever. But it works for a while, and you're getting your dividends and blah, 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 and everything's working out nicely, but then it takes another dive. Now, I'm sure something happened over here that you knew was happening, like they probably diluted or who knows what they did, but whatever it is, the point is that if you're in 670 and it fails, and I take it you weren't hedged or anything either, so it just failed and goes to 5, at the point where it's 5, you lost $1.70. All right? You got to get out. You lost 20% of your money. If you're not going to get out at 20%, here's the thing, if you're not going to get out at 20%, then you should be doubling down or looking to double down. Because had you doubled down at, if you'd waited for it to stop falling, if you don't double down just because you're down 20%, but if it went from 670 to 4, and you double down, now let's see what would have happened. So you go, so from 6.7 plus 4 is 1070 divided by 2. Now you're at 535, right? And then you're at 535, and you're hoping it comes back, and then it doesn't, and it falls again. Now you're at $3. So let's say at $3 you decide to double down again, plus $3, and we'll divide that by 2. And now you're at 417. That's not as disastrous. And especially, like I said, we're scaling in. So in other words, what I've done is let's say we ended up with we started out with 3,000 shares, then we went to 6,000 shares, and then we went to 12,000 shares, right? So let's say I have 12,000 shares at 417. That is times 12,000. I'd be at my full allocation at $50,000. That's, again, I'm not using any options or anything like that. I'm just saying, let's say I scaled it and I have 12,000 shares at 417. But the thing is, I have 12,000 shares and I have $50,000. I have 12,000 shares for $50,000. When it was at 670, if you took $50,000 divided by 6.7, you would have only had 7,400 shares. So this is the point about scaling in, because we scale into a position, even if the position goes dramatically against us, and I'm not even talking about hedging with options here. I'm saying if I just bought an allocation, and I bought a 1/4 allocation here, and I bought another 1/4 allocation here, and I bought a 1/2 allocation here, excuse me, and doubled down, I would now have 12,000 shares for the same $50,000 I was originally going to have 7,500 shares for. And those 12,000 shares times 0.48 are paying $5,700 in dividends each year. So that's still 10% of my original amount, of my $50,000. And again, that's without options. So I'd still be getting back 10% on my money. And by the way, all the way here, I was getting those dividends. You did not get your dividends, did you? In fact, I remember you saying, I don't know if you're the same one I was talking to in chat. I think you mentioned something about getting dividends. So let's say you collected $1.67 in dividends over that period of time. That then would have driven your net down. Well, it wouldn't be on as many shares, but let's say that would have knocked another $1,000 or so off your. I'm sorry, 1,000. let's say 2, 3, 4. Let's say another 10% off. It would have taken that 10% more off the price. All right, so it would not be that traumatic where you are now. But scaling in is a critical factor here. If you just enter a trade and put all your money down at one thing, if you start out with a full allocation, you're going to get screwed. Of course you're going to get screwed. Because if you start out with a full allocation, there's only one possible outcome where you win, and that's if the stock goes up. Any other outcome is stock could go flat, a stock could go down, a stock could go up. When you put all your money down at one time on a stock, it had to go up or you lose. You have no other way to win. You've completely cut off all your alternatives. You've backed yourself into a wall because you spent all your money at once. That's a terrible way to play the markets. Okay, so you're saying you did have a plan and you got out. Well, that's completely irrelevant to this conversation then. But you get the point. In other words, the point is if you have a plan and you watch your plan, you're either on track or you're off. And if you go into your allocations sensibly, if you take partial positions and build them up over time, then who cares if the stock drops 50% because you're just going to buy more. And you'll have a lower basis. And then when it does finally come back, it'll be better for you. That's the key. But now Francisco, he's saying he got out. Well, that's fantastic that he got out because that's what you're supposed to do. If you don't like the way it's going, you get the hell out. So what was that second point? If the trend keeps in 6 months, ARR will be at 150. If the trend keeps up at 6 months, ARR will be at 150. But you know what? So will our net if we keep going like this. But it won't. But like I said, I don't think it will be. So if like I have other reasons that I think it'll be good, other than staring at the chart and saying, "Oh well, look, the line's going down." Therefore, that's not how it works. Let's see. Craig says, if China possible, FXI be your preferred place still. If China, yeah, FX. I mean, I'm not interested in playing specific Chinese stocks at all. And it's just FXI is full. There's so much junk in FXI that's propping it up. The banks are solid, but the other companies around the banks are not good. There's a lot of bad stuff in China, and it's just a mellow plan. I'm not looking to make $1 million on China. I'm not looking to be Hugh Hendry. Who's the guy, Paulson, the one who called the housing market? It's not my play. It's just a thing. It's like China got too expensive, so we played it. I'm not Mr. China. It was just obviously too high, so it was obvious to short it. If something else was obvious, Netflix was obviously too high last week. We obviously shorted it. It's not. I don't care that it's China. I really, frankly, have lost interest already at this point. Now that we're out of it, it's like wake me up if it goes high again. Other than that, I'm not going to care. Let's see. Urschel says, what are your thoughts on gold going to expirations? Well, my thoughts are it's going to hold 1180. Otherwise, we're going to not make our full 100% on that bet. I think 1180 is the right price, and I think it's going to kind of drift around into that price. That's what makes the most sense to me. Mike Wargar says, no picture on table. That's very cryptic. I don't know what that means. Francisco says, there they are. Ken saying, if you still like Harmony. I do like Harmony, but they're hard to like. I like them because they're a small miner that kind of knows how to survive, and I always enjoy that, but they're down in South Africa, and they have not, they got killed because their mining operations are fairly expensive. It costs them a lot of money to pull gold out of the ground. And so low gold prices are just torturous for them. We haven't bought Harmony ourselves for any of our portfolios in ages and ages, years, I think. So I guess the answer really would be no. I don't. I like Harmony in that I like them as a long shot play. But do I actually like Harmony? No, because we never really end up putting our money into them. I'd rather if I'm going to speculate, I'd rather speculate on NAK than Harmony. Oh gosh. Yeah, this is where we liked Harmony, and then when it went up, we got out, and that was the last time we played it, and that was way back in 2011. Since then, we just have had no interest in chasing them. NAK I like because NAK could be a 10-bagger. Look at them there. What were they? They're 39 cents. They have the rights to a gigantic field. They're constantly fighting the EPA. The federal court rejects the EPA motion to dismiss the lawsuit. Oh, that's good. Wow, why are they going up? Northern Dynasty is suing the EPA because they think that the regulations that are not letting them mine their gigantic reserves of gold. It's possibly the world's largest copper mine with substantial gold reserves and molybdenum, which is also valuable. Huge amounts of it, and it's up in Canada and Alaska or whatever. This is a very, 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 very good, obviously Alaska because it's the EPA. They've got an annual meeting. They set an annual meeting. Here's their financials. AG Henry schedule. I haven't been paying attention to them daily or anything, but this is good news, though. I don't understand why this is not being treated as better news. Let's see what happened. Northern Dynasty, Pebble Partners, alleging the U.S. Environmental Federal Abuse, Advancing Bristol Bay Watershed Assessment Study, subsequent preemptive veto under the process, federal decision, so the judge rejected an EPA motion to dismiss the case. All he really did is reject the motion to dismiss the case completely. The EPA saying the thing is frivolous, and Northern saying this is our whole thing. It's like we want to have a hearing on the validity of this lawsuit and these actions. So what they're basically doing is they're suing the EPA to allow them to mine. If they win, though, this thing is going to go through the roof. If they lose, it's worthless. But it's the kind of thing where, like, if you have, if you have $400 to throw down on this thing and buy 1,000 shares for $400 of this stock, you might end up getting 4,000 back. So that's the kind of play it is. It's like you'll probably lose it, but there's I would say 25% chance that you could win. And so, for me, it's like as long as the risk-reward ratio is positive, I'm kind of happy to do it. And again, it has to be money, though. It's like a crap roll. It's like saying, craps, if you hit the 7, you double your money, but there's only a 1 out of, I forget the odds of 7s, 1 out of 6 or something. So it's got to be worth playing. And in this case, it is worth playing, though, because there is a chance that they can prevail in court. They've got enough money to have a good legal team backing it up. They're suing the EPA. The EPA doesn't have money to have a good legal team. The case law is iffy one way or the other. This is a very good sign to me because if the judge isn't going to reject it, because the judge could have rejected it and said, I'm not going to rule on something like this because it's easier for the judge not to rule on it because it has some pretty serious environmental repercussions down the road, and some guys want to avoid it. But this guy might be wanting to make a conservative statement, especially an Alaska judge is going to want it might be on their side because he loves to like strip mine everything. So we'll see. But it's interesting. So anyway, I like them as a speculative play, but there's nothing I like better than ABX. And I bet ABX's chart looks crappy too, so I won't worry about that. Yes, the ABX, terrible chart. But I'm willing to put my foot down here and say, look, they've got a lot of gold. In fact, if you look at the profile of ABX, maybe it mentions it. Okay, their gold reserves, they sold off a lot of the gold. They have 93 million ounces of gold and 9 billion, and by the way, 9 billion pounds of copper. Now, copper is what, like $3 a pound, is that right? Hang on, I might have a chart. Yeah, $3. So copper is $3 a pound. So there's 18 billion in copper, and we've got 9 million. There's 93 million times, how much is gold now? It's 1180? 1180. That's 109 billion, and then plus, copper is like 30 billion. That's plus 30. So let's still call it $109 billion. What is this? HP supporter system. Cancel. Who cares? Oh no, I'm sorry. It's actually, it doesn't matter. Those are the billions. There's 109 billion plus 30 billion, so 140 billion. So basically, ABX has 140 billion dollars worth of copper and gold in the ground. The company is being valued at $13 billion. All right? Now, obviously, though, it costs some money to pull the copper and the gold out of the ground and the copper out of the ground. So, depending on what it costs them per ounce, the difference would be the value of the company, basically. So you're talking about, plus there's time factor and so on and so forth. But if it costs them $1,000 an ounce to pull the gold out of the ground, and they're selling it for $11.80, that means they're only making $180 on the gold times 93 million is 16 billion. So in other words, so what they have, forget the fact that it's $140 billion worth of gold, it's $16 billion worth of profit sitting in the ground, and they've got a $13 billion valuation. But that's not how I look at that, because I look at it and say, well, wait a minute, because what happens if gold, instead of them making $180 times 93 million, what if they make 280 or 380 or 480 or 580 as gold goes higher? Then the value of this thing doubles and triples and quadruples as gold. Every $100 gold, every $100 gold rises, this company doubles in value. Now, you could also say every $100 gold falls, this company has and will go to zero. And that's probably true also, but realistically, they're minor, they'll cut back, they'll scale their operations, so on and so forth. As long as they survive long enough for gold to make a comeback, whenever it makes a comeback, they're going to make a fortune. So if you want to play gold at all, that means you believe gold's going to make a comeback, so then this is the most logical way to play gold, is by playing ABX. And it's so cheap to play here at 11.17. I'm not buying it because I think they're going to make money this year. I'm not buying it because I think they'll make money next year. I'm buying this as a way to hedge gold. Because if gold goes up, it's not like their costs are going to change much, and all of a sudden, boom, this company will explode and make profits. But as long as gold's down, they won't make a penny. And they're going to continue being crap like this. So you have to be willing to ride this out for a very long time. Okay. Sandra says, we have a USO 7 times 20 calls and the short calls and USOs over 20. Can we hold it or whatever? What, did we forget to do something about that? Whoa, what did I do? What is that? Short-term portfolio? USO. Is UCO? USO. What are you talking about? We have the USO 7 times 20. I don't know where these are. Where are these things? What portfolio are you talking about? All right, anyway. Well, to partially answer that question, we do have USO, well, this is 2017. That's not even relevant. We have a $15 put, so that can't be what you're talking about. I don't have any USOs here. Do we have them in the short-term portfolio? I don't remember having them in the short-term portfolio. No, I have no idea what you're talking about. All right. I mean, if you have something, let me know what you have. I don't know, where's USO right now? USO's at 20, so all right, you have to clarify. What else? Jaybird says, Mylan getting hammered says its largest shareholder of ABT is backing the Prairie Deal complex law situation. Really? What do you mean by hammered? Oh, that's interesting. Abbott's in favor of the Perrigo deal, so they're going to go ahead and do. I don't know. Why would that make it go down? I don't see anything in it. I don't know if there's any way we can make money on our position. Where are we with Mylan? Back in long-term portfolio, isn't it? Mylan. There we are. So what do we have? We have a small position, so we are looking to get more. We have the 65-75 spread. We sold the 60 puts. This is not very exciting to change. I mean, I guess we could sell more puts, but I'm not really inclined to do that just now. You know what? It's worth looking at. So maybe we will double into this position because it's actually, I mean, we're certainly getting a much better price on the short puts. And I still don't see any reason why they'd be below 60. So that could be interesting. But I think I want to wait to see where they settle down a bit first. Let's see. NYL. The thing is, though, when you have a day like today, you have a high VIX for change, and you've got the stock coming down for no particularly good reason. So, I don't know. I don't. Nah, I think I'd wait. I think we should wait. But if it gets down here, especially if it gets back to 65, I'd be hugely interested. I'm even kind of interested now though, because we get a pretty good price at the $60 puts. It's so unlikely that it's going to go back to 60. I don't even understand why those puts can be $6 at the moment, but we'll see. All right, what else do I want to talk about? We did our virtual portfolios. We had in June. We did the review this weekend, right? That was from the other day, and we looked over the 4 main portfolios. We did our top trade review in June. We got those Vickery Brown things too. Where did they go? I don't know where those went. So I put those in here. Let me take a look. I want to talk about those Vickery Brown trades in case we didn't get to them. When did I do it? Is the question. Yes, there they are. All right. So here, the entries we looked at on these. This is Vickery Brown. Scott Brown started a new investment company, and they're using quant analysis. So we decided to take their quant system. He gave me a list of 50 stocks that made their screeners. And we narrowed it down to about 16 of them that we went over day by day in member chat for about a week or so ago. And we narrowed it down to the 4 top picks that we liked. And those picks were, and this article right here, it's on, you know what, hang on a second. Let me just put it into, I'll put it so it's under the portfolio tab, because it should be anyway. There we go. Now it'll be easier to find. There we go. Not that we're adding them to our portfolios, but just that. You know, for me, this is like a watch list because we weren't particularly, we weren't in the mood at the moment to put it in our portfolios. It's part of a marketing thing between us and Vickery Brown, so we did it when we did it. Like I always say, don't force a trade, right? It's like we think the market's going down, so why would I be buying things now? But the ones we liked Wynn, which is Wyndham Hotels. They're generally, higher end hotel chain. They got a lot of good properties. Luxury travel is booming. And the only thing that hit them was currencies. Currency exchanges hit their earnings and they took a big dump, so it was a good time to pick them up. And they hit the screeners because when they fell from like 95 back to 85, they became good value. They're still drifting down. They're still on catching steam, so it's no hurry to get it. But I do have a trade down here for it. Let's see. See, it's funny, IHG is my favorite. Yeah, that was the one we picked at last November when we were in Las Vegas. We picked them back here. This is when I picked them, so they're doing pretty good, actually. Actually, it was what, November, right here, let's say, yeah, about this date. So we picked the year before they took off. Maybe they took off because we picked it, who knows? Because they were one of my top picks at the Vegas conference. So that could be just because we said it. Anyway, so going from 38 there up to 42 is not a huge move. It's only 10% really overall, but it's a good stock, and it's a nice thing. But this time we talked about Wynn, and for the same reasons, though, it's also the same. It's a very similar stock. It's a luxury hotel chain. They got a good future, and there's a reasonable way to play it to make some good money. That's Wynn. Tumi was another one, and Tumi is a luggage company, of course. This one I love. We're picking them up way down here after this big fall, and again, very, very bad exchange numbers. People who make stuff in America and sell it overseas are getting totally screwed by currency fluctuations. So there's nothing wrong with Tumi's business, really, other than the currency fluctuations. And this is the thing. I love when I see it, whenever I have a company that's on a watch list of ours, that we like the company in general, and this was from our buy list, Tumi is one that we do watch all the time. Because we know, why do things make a buy list? Things make a buy list because when they're cheap, we want to buy them. That's what the buy list is for. So here they are, cheap again. Haven't been cheap since last fall. So here they are back in the place where we like to buy them. And when they go back here, we'll sell them. And then when they come back here, we'll buy them again. We don't have to marry it. We just have to play it when it's low. But at the moment, it's at 2076, or it was anyway. I don't know what it is today. Here it is. Oh, look at that. It really took off. Oh, it already took off on them. Sorry about that. Well, not so bad. 2150 looks like a lot. It looks like a lot more than it was. But they've come up off that low already since we started looking at them. And here we're able to do the we're doing let's see the calls. We're buying the spread, the 1750-20 bull call spread. So we're basically calling a forward 20. Going with a 1750-20 bull call spread, selling the $20 puts. The whole thing nets out to a credit of like 20 cents. And it pays back $2.50 if it goes well. This is a good trade. Constant Contact was also interesting. Again, they came down. They had a big hit on earnings, but they're basically they just had a little hiccup basically and went down. But I still think this becomes a good value for them, and Vickery agrees with me. So I like the way to go on that. They unfortunately had short-term puts, but we had a good trade to play. So we said here very simply, just sell the December 30 puts. They're down here at 30. Here's 30. You sell the 30 puts for 420. That puts you in at 26. 26 is way down here. And so if they go up, you're going to make $4. It's a good little trade. IPG is into public. It's an advertising company. Very boring business. Boring businesses, they went up. They were on a great track. They fell off track a little bit. They'll get back on that track, and they'll be up here at some point. So again, here we went with the bull call spread, selling the short puts. All right, so that's 4 really, really good trades that are right there under the virtual portfolio tab, right here. And that's always a good place to look. If you're a member, you're always going to get some good trades there. I always put things, either we have, the best things to play when you're looking in this, these are our reviews generally. But we got the June portfolio review, and anything that's going against us that we still like, just watch. Here's what I write. There's nothing better than picking up a trade after we already lost money on it, right? Because then that way you're getting a discount to what we paid. So here you'll see good for new entry, good for new entry, good for new entry, good for new entry, good for new entry. All right, so just because these portfolios look static, brand new, good for a good entry. If they got away, I always try to mention if it's good for a new entry, ABX. In fact, right there, ABX. So if something's good for a new entry, that's the first thing I'm going to tell you. Is I'm going to say, look for these stocks, look for the ones that are good for a new entry, because those are the ones that you can just play right now if you're looking to fill up your portfolio. And then we did the June trade review here. I was going to say, if we have a buy list, it would be here, but we haven't had a buy list in a while. May, top trade reviews. Top trade's also great if they haven't moved yet. God, we've been killing it on top trades too. We have been unbelievable proportion of winners on top trades. March portfolio, nope. I swear there's a buy list in here somewhere. Oh, Secret Santa inflation hedges. Oh, those are still probably good. Do we have these Secret Santa's inflation hedges? Certainly haven't been too much inflation yet. December portfolio. Thanksgiving top trades. That was when we started top trades, I think. October portfolio. Oh, for God's sake. The buy list. There it is. Jeez. September of last year. 40 stocks. It is going to be time for a new buy list if we have another sell-off, but we haven't had a sell-off to make a buy list about. So what was on the buy list? We had ABX. We had AGNC, who we were just talking about, the REIT. We had ACAM, which has flown up. We have Broadcom, which is gone now. It's basically getting bought, so it's out of here. BTU, way worse. That one killed us last year. Cake went down and then went back up, which is good if you're scaling it and bad if you're just riding it out. CCJ is still laying around. Still like them. CHK, it was good because it went shooting up after we went into it, then it crashed back down. We are kind of interested again here, but not too interested. I like Encana better now. Here's CIM, perennially, that we like them. Here's CLF, which has been terrible. CLF had a terrible, terrible time. Went down here. Here's DBA, which we are still loving down at this price. eBay took off on us and went away, so we can't play that anymore. Ed is pretty consistent. They're back. Well, it says right here, back to bottom range at 55. So it was at 55 when we picked it. It went way up to 70, and now it's back to 55. So, yes, we like it again. That's a good thing here. I try to remember to write that when we're doing, like, where the price is at the time. Otherwise, it gets confusing. EXC, they're a good steady payer. FCX has done well since we picked it. GSK, they've been they were up for a while now. They're back down. Still like them for that price. GLL, interestingly, has actually gone along pretty well. But we were playing the short. Actually, the 77. We had a bear put spread, which worked out because it was down here. But then it stopped working out at that time. I don't know why I put that in. It's too confusing. HK, not really. ENP did not work out at all this year. It's been terrible. But they're basically back to where we had them. Harmony, here's Harmony. And we said it's another beaten down miner. And it's a good stock if you remember to get out when they go higher. Now here's the thing, it went much higher. And if you didn't get out, you got problems. Now same thing here. If you get it here and it goes higher, you got to get out when you take those profits. Hovnadian had a good time and now it's having a bad time, but we like it again down here for sure. Hewlett Packard. When did we do Hewlett Packard per se? They were at 38. Now they're at 32. So they are cheaper now. I don't know if they're better. They had a little bit of a run up. They went higher into the 40s. But we planned on owning them from that 29.60. Well, we're getting our wishes, aren't we? So what we did is we did a sale where we sold the 32 puts for 240. And this is exactly on. So basically, we're exactly on target. This is where we thought they'd be. Now, though, it's a good time to add a bullish spread. I'm going to redo this bio. There's plenty of good stocks still on here. IBM flew up on us, unfortunately. That can't be played right now. IGT really took off, and now it came back a bit. I like IGT. iRobot, we always love iRobot. They've been doing pretty good. ISRG, huge gain, and all the way back down again, and now I like them again. It's so much fun to play these things over and over again. JDSU also, they had a nice top. Now they come back to earth. KVH, we have these actively in the long-term portfolio now. Lionsgate Film, that one went away from us now, unfortunately. Lulu is kind of rangy. We are playing them somewhere, I think. I like them. Mattel, I don't know where we started with Mattel. What do we do here? Sell the 2016 33 calls for 370. Uh-oh. So our net here on Mattel is 30. So we actually have not done well on Mattel. That's below. That's still below where we expect them to. So this one I'd still like for a new entry. Newmont Mining not doing so well, along with ADX and everybody else in that thing. NLY, as we talked about with the REITs, flatlining basically, but also a good price right now. See, our net was 965, and they're at 984. NTAP has been drifting down and down, so that hasn't gone too well. And we did this in the, we did that in the STP at some point. I guess we're out of them already. These were in the STP, but we already took the money off the table when they went flying up. New York Times actually done fairly well. Pfizer's done well. PNW not well. Another dividend payer. Another guy who pays out all the money in dividends and just keeps going down. RIG actually is starting to recover. RIG's a funny one. I like them down here. RRD, we always love these guys. They pay a really good dividend too, and they're a good, solid performer. Here's Sears. We got out of Sears, thank God, because they're completely in free fall now. Taser, we love, of course. That's been going great. Textron, they were doing great, and then now they slipped off again, so maybe we can get a new entry again on these guys. UBNT, they took off, they're gone. Wendy's is gone, huge gains. And Whole Foods came back down. All right, so that's our buy list that's our old buy list. Don't forget we got out of all these guys in March and took all our profits off the table. But now, a lot of these stocks we're going to be looking back again. It's a year later almost, and we're going to start looking at these stocks again for good entry. And those are the cycles, though. That's the thing. You can't say a stock thinking it's always going to go up. Just because we have a buy list, we got out of all these stocks already. We cashed out some in November last year. We cashed out some of them in March. Other than RIG, I can't think of any of those guys that we actually kept because we had taken our profits off the table already. But the point of having a buy list is when things get cheap, you say, "Ooh, now's a good time to buy it." So there's 40 stocks here that you can look at for ideas and say, "Hey, this is cheap." And of course, come, and then mention it in member chat and say, "Hey, this thing's down at the bottom of the range. What do you think about an entry now?" That's how we get a trade started sometimes. All right, well, I'm losing my voice, so it's time to start wrap this thing up, I think. Let me just check if there's any additional comments that I can talk about. Oh, no. You guys are so unchatty, it's amazing. I wasn't able to get into the BA trade because the 2017 bull calls went to 1140 soon after you posted the trade. Just trying to be patient. So you didn't get the put sale either? I mean, that's a shame, I guess. Where is Boeing? What's Boeing doing? They're selling a lot of planes, man. I don't know. I mean, I have to tell you, honestly, on that one, I don't know what to tell you. I think I would probably pay the 740 and sell a higher put because it's just, I just don't see how that's not going to pay off. I think Boeing's going to be in amazing shape. They took so many, they only sell with Yahoo. Here we go. If you look at Boeing's income, see, they only sell $100 billion worth of planes in a year. They're currently backlogged for something like they're currently backlogged for like $500 billion worth of planes in their deliverable. So they've got 5 years worth of orders stacked up already. So as much as they can produce, whatever factories they want to add up on, as fast as they want to ramp up production, that's how much money they're going to make. So they've got years and years of steady growth ahead of them. And even now, currently, even at 142, their PE is still under 100 billion. I think that's holding them down. I think the 100 billion line is holding them down at like 145, 150. Even so, their PE is currently 1783. Their projected PE next year is 15.32. They're paying you a dividend of 364, which is 2.5%. Not that you're getting it in the setup we looked at, but this is a good, solid stock. I really, really like Boeing long term. I think it's a great play. Anyway, so I don't think it's going to go below 140. I think that now that the air show is gone and they're winning the air show as far as orders go, I don't see how it can be below 140. I don't think it's going to happen again. All right, guys. So that'll be it for this one. Oh, wait. Suddenly Craig starts talking. Robbie says, what do you think of TF up here? Oh, yeah, let's take a look at where things are. I don't even know where things are at the moment. Got totally lost in conversation. What do I think of TF up here? I think I'd like to short it, but I think it's too scary to short. I mean, there's nothing we can do right now but watch and see where these bounces work themselves out to. We expected a weak bounce. We have a weak bounce today, a little better than a weak bounce. But basically, it's a weak bounce so far. The Russell's up at the strong bounce line. So tomorrow we'll see if they fail or if they follow through. And you got the Fed tomorrow, too, so that's a complete wild card. So, what do I think? I think I wouldn't want to bet it because that would be crazy. I think there's no way you can make a prediction on what's going on right now. It's not likely the Fed is going to tighten tomorrow. If they do, that would be really surprising, and the markets will probably drop fast. I think it's more likely they talk about holding off until September. That's going to be good for gold. It won't be that bad for the dollar, but it'll probably knock the dollar down a little, and that'll probably bring us to like our strong bounce lines. But then the question is, what happens there? And if we fail again at these strong bounce lines, or if we fail the weak bounce lines especially, then that's a bad signal. We're probably going to break the low to lower lows coming up. But I wouldn't want to guess on any of the directions of any of these things right now. It's just way too crazy. Look at oil and oil not making 60. That's sad for oil. They can't get over 60 on a rally day like this. It's not good. And Brent's down. So Brent's down and our oil is up. So that's an interesting combination. It might be worth a bet almost. All right. So let's see. All right, last thing I want to talk about is what Craig and Scott saying. If the Fed announces a rate increase, what would oil do? Oil, if the Fed announces a rate increase, that's going to strengthen the dollar and knock oil down. And not to mention the fact it would theoretically put a damper on commerce, which would knock oil down. So there's several reasons oil would go lower if the Fed increases. If the Fed goes flat, or if the Fed extends, that would probably be the better thing for oil. Craig says, I've been holding Berkshire B and Disney in an IRA. Are you so bearish that you would dump and try to lower or just hold these? I don't know. If you got them naked, I would sell. I'd rather have cash. I would certainly cover them. I mean, you got an IRA, you can sell and cover calls on your stocks. I would have sold both of them a while ago. We went bearish on Disney when they topped out, well, it's not that far off, actually. We went bearish on Disney up around here. So when it got up to here, to the 112 line, we decided it was high enough, and we changed our stance in the butterfly portfolio. And Berkshire, the thing is we're going to probably get a market correction. Disney is going to have a fantastic summer. They're hitting it on the movie side. Is it point B or dash B in this thing? Disney's killing it on the movies, and the park attendance is huge, and they raise their prices, so they're going to make mega bucks this summer. So they're not going to have bad things, but I just think they're overpriced a little bit here. Berkshire, too, though. I just think Berkshire at this 150 line is going to have a hard time getting over it. So I would have gotten out at 150 and not been greedy. At 140, I don't know. But at least I don't understand why would you just hold the stock, though. I don't get it. It's not a stock that's going to double on you or anything like that. It's going to, it's going to sit there mostly. It's going to run with the S&P. Berkshire/B. Look, the stock's 140, and someone will pay you $10 for the 150s. For the 2017 150s, or $14, 10% for the 140s. Frankly, I wouldn't be in the stock at all. I would be in a bull call spread and sell the puts. I don't know. I wouldn't. It's not a stock I would hold in an IRA at all. I don't see the point. It's a proxy for the S&P. Yeah, it's okay, but unless you bought it for a good bargain, it ain't going that much further up. Because you're in an overpriced market, and Berkshire's a reflection of that overpriced market. They're better than the S&P. I would rather have them than SPY, but I just don't. It's just they're stuck in the same problem as all the major corporations. They're not going to have any great growth because the consumers are being killed, because the middle class is being killed. There's not a lot of growth to that down the road. And when the Fed starts tightening, it's going to affect the businesses. Their borrowing costs go up. Blah blah blah. I don't see great growth there. And obviously neither do the people who are buying options, because these guys are only willing to pay you 10% for 2 years or for 18 months. On the other hand, though, if I was going to play Berkshire, I would buy the 115s for what, $31. I would sell these things for $14, the 140s. So what, 31 minus 14 is $17, right? On that spread, on the what is that? On the 110, 140 spread. So it's $17 for the $40 spread. And then I would sell maybe the 125 puts for $6. And that would knock me down to $8 on the $30 spread. So now I'm going to make the same 20 that you're going to make, except I make it at 140. I don't need the stock to go up. And my worst case scenario is I end up owning the stock at 130, which is lower than you own it for now. So what is your advantage of having it in an IRA? There's zero advantage. It makes all you're doing is tying up a lot of money to make a very little amount of money in order to save taxes on the money that you hope to make. That's just lunacy. I never understand why people do that. It really just baffles me. All right. That is it. Let's wrap this thing up then. Seems to be a character limit for chat. Oh, I didn't know that. That's interesting. All right. Well, I don't think there's anything we can do about that. If the Fed announces a rate increase, what would oil do? We said that already. And help them before I got into PSW. Yeah. You got to consider that when you're in an IRA, you have a limited amount of money, and you should really be putting in the things that you think are most likely to give you a large profit. Berkshire is not the kind of thing you're going to expect a large profit from. I mean, unless you get it when it gets to 90 in some kind of crisis. But if Berkshire's at 150, you don't expect it. It's very unlikely to get to 200. All right, and that's only like 20% up from here for them. So if you don't think they're going to make more than 10% a year, then why in your IRA would you tie up the money? The IRA should be used for stuff that you think you're going to make 50%, 60%. The IRA should be on stuff that you're going to really make money on. Because the only reason you're in the IRA with all those restrictions is to shield it from the tax gains, right? It's your current portfolio, where you're paying taxes, is where you should have the things that aren't going to make you much money. Yeah, right? Let that be the place where you hedge and do things and have these plays in your current portfolio, and let the IRA be the place where you make the profits. And think about how you can split up your trades between them to reflect that. That's you got to be. There's a way to play an IRA, but you got to really juggle this sort of thing and figure it out. Use the tax-free part to your advantage. Because you can break up a trade, like you take Berkshire. In other words, like the spread we were just talking about, right? Let's say you could only buy the call. So you just buy the call in the IRA. That call is going to make 20%, 30%, 40% on the call. Meanwhile, the short call you sell in your live portfolio is going to offset the gains of that call. And then you'll pay less taxes on what's offset, because you're going to lose money technically on the short call while you make money in your IRA. It's a way to transfer money from your short-term account to your IRA, in fact, right? You're taking the losses in your taxable account, putting the gains into your IRA account. See how clever that is? And that's how you get past the limit. That's like Mitt Romney has $300 million in an IRA, because he knows how to play that game. All right, guys. Well, that's enough of that, and we will do it again next week. And I hope everyone got their audio problems fixed. But we'll continue to work on that if there's any of those left. All right? Thanks.